I mean, the recession is coming. In my estimation, earnings are going to fall anywhere between 10 and 30%. That means the S&P is going from anywhere between 2,000 and 3,000.
Hi, I'm Kaiser Johnson with Liberty and Finance, and this is the Miles Franklin Weekly Special for October 18th through October 25th, 2022. This week we featured 2023 Britannia in silver and in gold. Though the UK's Royal Mint has finalized a portrait of King Charles III and has started minting commemorative coinage with his image, the Mint made the unexpected choice to issue this first run of 2023 Britannia, still bearing the portrait of Queen Elizabeth II. The silver Britannia comes in tubes of 25 and mint fresh monster boxes of 500 coins, and is available at only $7.50 over spot. The gold Britannia is $85 over spot while this shipment lasts. Our number for all orders is 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Welcome back to Liberty and Finance. We're always delighted to have this returning guest who is wildly popular with our viewers. Michael Pento is an active money manager at Pento Portfolio Strategies. He joins us again this Friday, October 21st, 2022. Michael, thank you for coming back on Liberty and Finance.
Always great to be with you, Mr. Kaiser.
You add a lot of sanity to our lives in your analyses of the current state of affairs in our financial markets, and you put out a publication. I used to call it the midweek sanity check. I think it's the reality check, not the sanity check. But anyway, and always grateful for your visits here. It's been a little bit too long because we usually get you more often than this, and that was my fault. Grateful that you're able to come back on now. And we're looking to you at this time for your overall assessment of the increased risk that we're hearing about in the U.S. Treasury market, illiquidity. Janet Yellen saying a couple weeks ago everything's fine. Now a week ago saying, well, actually there's some strains. Now just yesterday, Bank of America announced through MarketWatch, fragile Treasury market is at risk of large-scale forced selling or surprise that leads to breakdown. B of A says, what's Michael Pento's sanity check, I'll call it, on the actual risks that we're facing right now in the U.S. debt market, the Treasury market, and because that's something that people look to as kind of the center of a big system that could have wide-ranging effects on other things.
Well, how you doing this morning? Are you disgusted? You should be disgusted this morning. I am really disgusted and aggravated this morning. Let me tell you that. So, for the better part of 14 years, Dunnigan, the Federal Reserve has been practicing zero interest rate policies and engaged in some form of quantitative easing, various amounts, between 50 billion, 85 billion a month. For 14 years, they have done this. Finally, in March of this year, after 14 years of monetary and fiscal madness, they started down the road to normalcy, raising the Fed funds rate, off of 0% and getting it, in their view, to a restrictive policy. So after 14 years of profligacy, if I said that right, profligacy. 5 months, 5 freaking months. And we had today the article from the Wall Street Journal from the Fed Whisperer saying, maybe starting in December, after the 75 basis point rate hike that we're going to get November 2nd, maybe we're going to stick the landing and just maybe hold rates there, or just take a pause and see what's going on around us. Isn't that amazing and disgusting? In 5 months, it only took 5 months. They only started normalizing policy in March. 5 months as opposed to 14 years, and we're already seeing them panic. They ain't even done again. They're only at 3%. They're not at 5, not 4, 3. 3% historically is a very low Fed funds rate. QT in all of its glory, let's just look at quantitative easing and quantitative tightening. Fed's balance sheet was $800 billion in the end of 2007. It rose to $9 trillion. Well, it's all the way back to 8.8 something trillion dollars. Now it's almost 8.9. So after building the balance sheet up by 8 trillion, over $8 trillion in base money supply, they managed to withdraw 100 billion. And now they're panicking because credit markets are starting to crack. Sovereign CDS spreads are blowing out around the world. As a matter of fact, this morning, I come in this morning, wake up at 6 o'clock in the morning. I click on to see what's going on with the treasury market because that's the nucleus of everything. See what's going on with the dollar. The dollar is surging. Long duration treasury yields are up another 14 basis points after being down 30% this year. And then all of a sudden, mysteriously, we get an article that, hey, we've gone too far, maybe we should stop. So what does this tell us? Where does the rubber meet the road? The Fed is, as I said the whole time, the Fed is going to aggressively try to normalize policy. They have done that. They're going to fail miserably and destroy the entire markets, everything, fixed income market, crypto market, SPACs, junk bonds. They're going to destroy everything. The credit markets are going to freeze. My guess is by the end of the first quarter of 2023, and then you're going to get your big dovish capitulation. And that is, by the way, what I've been waiting for. And I won't wait till that exact time because my model will pick it up ahead of time, hopefully, God willing. But that's when I'm going to increase my goal position because guess what? They're never going to be able to prosecute on their plan to raise interest rates to 4.5%, 5% in early 23 and then keep them there for a very long time without destroying what they've created. And the reason why, and I'll let you in a second, I just want to wrap this up. You just can't deform markets for over a decade, 14 years plus. Actually, you go all the way back to the year 2000 or even 1987 if you want to. You just can't manipulate markets to that degree where the risk-free rate of return is basically almost zero. We got down to 33 basis points in the 10-year note. You just can't do that without creating massive asset bubbles and a huge amount of leverage and debt in the system, and of course, inflation. And you just can't back out of that innocuously, to put it mildly.
Right. It kind of reminds me of families that raise their children but don't provide any discipline and that sort of thing, and then suddenly think that they're going to clamp down in their teenage years or something like that. It's like, no, you haven't laid the foundation, or you did lay the foundation, and this is the bitter fruit that's coming from it. So can you talk to us about what you think the fallout will be from such a pivot to a neutral or easing stance should it happen here in the fourth quarter?
Well, I don't know. Again, I don't think it's going to happen. I'm not sure it's going to happen in the fourth quarter. I think by the Q1 it's going to happen. But of course, that's my best estimate at the time. But it's not going to be. I don't think it's going to be the normal pivot. So normally, when you think of a pivot from the Fed, you're talking about, hey, oh my gosh, we have a problem here. We're going from in 2008, Bernanke went from 5.25% to 0 in just a matter of months. It took them less than a year to get there. And we got better at it all the time. In the pandemic, we went back we were at 1.75 to 0 in weeks. So we're getting better at going how fast we get to zero interest rate policies. I don't think we got back to 0. What I think they will do first is say, oh, let's put a salve on this thing. Let's just like they did in 2018. Remember in December of 2018, the Fed funds rate was 2.5%. The Fed, what did the Fed say? The Fed promised to stop hiking. That's the first pivot. Then shortly after that, by July, in July of 19, they ended quantitative tightening. We're going to follow, I think, something very similar where we We just first stopped promising to hike rates, and then we stopped QT. But the damage is going to be severe during that time frame. I mean, the recession is coming. In my estimation, Dunnigan, earnings are going to fall anywhere between 10 and 30%. That means the S&P is going from anywhere between 2,000 and 3,000. If you do the math, just at 13 times earnings on the nadir of the 30% decline, 15 times on just a 10% decline. So maybe we go down. The minimum we go down to is 32, 3,300, but we can go all the way down to 2,000. There's going to be a lot of damage done to the credit market. So the pivot is going to be attenuated and protracted as compared to previous times. Meaning, in other words, instead of going right back to zero, we're going to slowly go back to zero this time, much more slowly. If we even go to zero, maybe we go back to 2. And quantitative easing will just be on the periphery. So maybe they, instead of promising to buy everything like they did in the pandemic, they said, give us your junk bond, give us your corporate debt, give us your commercial paper, give us your mortgage-backed securities, give us your treasuries, give us everything. We have an unlimited QE policy here. They're going to say here, we're going to have a limited window open for you to send us your paper, but it will be at a penalty rate. So that's what I'm thinking. So in other words, I guess if you want to wrap this all up, we're going to have a recession. It's going to be very salient, very acute, and it's going to last longer because the Fed pivot can't be the same, knowing that 40-year inflation was just several months ago. 40-year high inflation. It just can't happen.
Okay, so that's the direct effects of such actions if they take them. What do you think might be likely indirect or psychological effects on market participants and so on when they see this change in behavior by the Fed?
Well, I think it's going to be really good. I mean, I hate to say it. I know you hate to hear this, but it's going to be really good for the precious metal market. I mean, we're going to finally learn that what we knew all the time is that hey, you can pretend and scare the precious metal complex into thinking you're going to have real interest rates forever, but you can't. The economy is so over leveraged and so addicted to asset bubbles that real interest rates just don't work. So we're going to put a cap on nominal rates first. That's the first thing we're going to do. So we're sort of like what Japan did. Maybe we just say, hey, listen, the 30-year Treasury can't go any higher than 4%, whatever the number they get. And they're going to do that by creating money, which is inflation. So real interest rates will then fall, which is rocket fuel for precious metals. I mean, I've been out of the market, other than a small physical holding, 5% physical holding. I've been out of the market for most of this year. Correctly so. I'll get back in when I have a very good feeling. The model gives me the assurance that nominal rates have topped out and real interest rates are going to fall. That's coming, I think, by Q1 of next year, as I said.
Yeah, we did an interview, gosh, it must be a year now ago, with Rick Rule talking about when will he sell his gold. And he outlined, I think, at least 4 different conditions. And one of them is when we see real positive interest rates again. He said, until we see that, and we haven't yet, really.
Well, it depends on what you're using for inflation. I mean, real interest rates, if you look at break-even spreads, we are positive. If you look at CPI, we're very negative. But it's not the actual number. It's the rate of change that I look at. So real interest rates are rising. That's undeniable, and everything's predicated on that direction, that rate of change. So that's why gold and gold stocks have been horrible this year so far. They don't like rising real interest rates, not actual real interest rates the way you just calculated it using a CPI deflator, but just the direction of real interest rates is no good. And the dollar. So if you have real interest rates that are rising and a soaring U.S. dollar, it's not good for gold. I think the exact opposite condition is setting up for next year.
And speaking of the CPI, your latest thinking on, are we getting any more truth? You mentioned being disgusted at the beginning of this conversation. Are we getting any more truth from the keepers of the information about what's happening in terms of inflation than we have been for the past year or two? What do you think about that? And then number 2, what do you think the actual, how do you view measuring inflation, and where do you think we're at and where we're headed?
Well, they've done a great job since the 80s and 90s from covering up inflation. I mean, if you measured inflation pre-Boskin Commission metrics, before hedonics and substitution corrupted the number, we were at 17 to 20% inflation. In fact, if I could just mention some numbers to you. So if you look at food at home or at school was up 91. I'm just going to read one thing to you from the CPI. This is from CPI, Labor Department. Food at work or in school was up 91% year over year. I mean, think about that. That's absolutely incredible to me. So when you look at home prices up 20% in the last 2 years, each of the last 2 years, the Fed has made it impossible to heat your home, eat, pay for college, and eat. Did I say that twice? I'm not sure if I said it. So eat your home, pay for college, and buy a house. They made it impossible for the average, middle or lower class person to do that. Think about that. So they understand the error of their ways. They tried to fix everything, and guess what? They failed miserably. They failed miserably because they didn't understand how over leveraged the system was. If you look up some of the, in fact, I have a presentation. I hate to say this, maybe, but if you wanted to become a podcast subscriber, my podcast, the midweek reality check, the last one I did had a bunch of charts in it that showed you how I showed the actual leverage in the system, because I got so aggravated hearing from CNBS that, the consumer is in great shape and corporations are flush with cash and blah, blah, blah. I said, let me show you the numbers, government numbers, not I didn't make these up, on how over leveraged the system really is. So, the total debt right now is 800% to GDP. It's the highest it's ever been. Corporate debt, 50% to GDP. I'm talking about metrics to phony GDP. The nominal amount of debt is through the roof. And even household debt, even though it is down somewhat from 2008, the 2008 high was like 98%. Now it's like 70 something percent. That figure as a percentage of GDP is usually around 50 to 40%. But nominal terms, the household debt is up $3 trillion in just the past 3 years. So, I mean, there's been no deleveraging in the system nominally, and even in terms of the underlying economy, it's increased outside of the household sector. But corporate debt and government debt has exploded, and we're finding out. It always amazed me, Dunnigan, is how people on the mainstream financial media say, "Well, it's the government debt, so who cares? It's held by the government." Well, you should care, because the government doesn't have any money. So if the Fed's not printing that money and buying those bonds have to be floated to the public. And the public has to buy that debt at a certain price. So it does matter how much debt you have. And if the central bank's buying that debt, it creates inflation. So there is no freebie here in the real world of economics.
On your outlook for inflation going forward, what's your view of that based on your model and the forward-looking indicators that you follow?
So there's two areas of inflation that I'm most concerned about. So there's Main Street and Wall Street inflation. So remember back in 2008 to 2020, where they were desperately seeking Susan when it comes to inflation. We can't get to 2%. In 2019, it was 1.9% annual CPI. Just couldn't get to 2% at any sustainable basis. But we had inflation. Where was the inflation done again? Well, look in the bond market. Look in the real estate market. Look in the equity market. It was in asset prices. So the answer is we're going to have, and we're having, rampant deflation in asset prices. And we're heading towards disinflation, or at least experience a mild disinflation on Main Street, consumer price inflation. That's where we're headed.
Do you see that sustaining through into the next year and so on?
I do. I see sustaining until the Fed actually engenders a viable pivot. In other words, is able to re-inflate asset prices and the consumer price index. I don't see especially come November, Republicans are going to take the House, in my opinion. Strong opinion. I hate both parties, so I'm not being political. But there's going to be no rescue package for Joe Biden. Okay, there's going to be no fiscal rescue package for Joe Biden. And the monetary relief we're going to get is going to be, as I said before, attenuated. So you will have the standing repo facility tapped. You will be able to float commercial paper, some bonds, but it's not going to be this massive, unending, omnibus, all-encompassing, unlimited QE that we got before. Not the same. But when we might go down, I think we might go down that road again. It's just not going to happen in early 2023. That's as far as my model will go. I want to see changes in the G3 fiscal and monetary policies before. That's the major foundation of the model before I make my assessment of what happens next.
You've been describing this pivot to reinflating markets again, but that was kind of the problem statement that we talked about having happened for 14 years leading up to this. Is that move, when it happens, just creating a whole new Frankenstein all over again? This
is wash, rinse, repeat. This is the creation of the IDEC model, the inflation, deflation, economic cycle model. The predicate here is that we go through boom, bust cycles. It's been happening since the dawn of time, but these cycles are more intense and happening with greater frequency because of the artificial construct. There are no markets in Japan anymore, for instance. There is no market for JGBs, Japanese government bonds. There's none. So when you take the government and you usurp markets and put them in the realm of governments, this is what you have happen. You have huge boom cycles followed by massive bust cycles, and that's what's happened since the year 2000, and it's happening with greater intensity and more frequency. I don't see why that would change. I hope it changes because I'm disgusted and you're disgusted. I can see. Yeah, we put these 15 members of the FOMC, 12 voting members. We put these people in charge. But I didn't vote for them, and you didn't vote for them. Why is it that we have an unelected and unaccountable body dictating everything about our lives, what we pay for food, the cost of our money, the value of our savings, the amount in our 401k plan, the amount we have to pay for a house? It's all at the feet of these people, and they're destroying the middle class of this country. When are we going to wake up and say enough is enough? We had a gold standard in this country for a reason, because the mine supply of gold was basically equal to the growth rate of GDP, which is productivity plus labor force growth. So the amount of base money supply was geared towards mine supply of gold, about 1 or 2% per year. So you couldn't get these asset bubbles. They just didn't happen. They weren't pervasive, but they are now. We have a banking system that's gone amok and awry, and a central bank that has lost its mind. That can't happen anymore. We need some sanity in this the most important metric out there is the value of money. And we lost that.
Our audience tends towards late career stage and either transition into retirement or retirement age, and they're very concerned about the viability of their retirement plans, their retirement funds, anything that they're counting on for their retirement. You just mentioned the threat to this reinflation of the asset. You said where do people go? A lot of people are wondering, do they just ride this out and just sit this out, this stumbling and tumbling of the equity markets for the past year, for example? Is that going to get like a phoenix reincarnated out of the ashes here with a pivot from the Fed? Or do you think that people need to take a completely different approach that involves a more active way of managing rather than just sitting and waiting and expecting the Fed to always have your back and to bail out their retirement funds and their stock funds and everything?
Then again, even if what you say is true, even if it's true that the Fed is going to rise to the occasion and bring up asset prices like the Phoenix, depending on what you own, if you're a Cathy Wood investor, you're down, with 70, 80, 90%, depending on the time frame. You own long duration bonds since the start of the year, you're down 30%. Nasdaq's down 35%. S&P's down 25%. Even if it's true that how the Fed's got your back and they're going to reinflate asset prices imminently. Even if that's true, why do we have to suffer like this? You don't have to suffer like this. I mean, I've come on your program. I told people in in July in 2021, I warned people that 2022 was going to be a disaster. In late December of 21, we went defensive in the portfolio. We're only down a few percentage points on the year because whatever we own of treasuries has not worked for us at all. But rather than being down 30, being down 2 or 3, isn't that a big difference? Doesn't that mean a lot more to your sanity, to the way you sleep at night? I mean, suppose you had almost all of your capital preserved, and then when and if the Fed, more when than if, when that happens, then you could just take your money and buy assets on sale. Why not that's what we do here. So, I mean, I don't have to worry about, I'm not sitting there panicking, well, when is the Fed going to bail me out? Don't forget, there is no more communist nation in the world than China. They're the commie of all commies, okay? Not the people, the government. They control everything. Their stock market is lower today than it was in 2007. Japan has 0 interest rate policies going out over 10 years. You can buy a JGB for 1/4 of 1%. They do manipulate their money supply, and they do manipulate interest rates. They're not even close to where the Nikkei Dow was in 1989. So what am I saying? There's an end or a limit to how much the Fed can do to always bring asset prices higher. So I would be very cautious in the notion of saying, hey, you know what? I don't care if I lost half my money in 2000 and half my money in 2008 and half my money in 2020 and half my money in 2022. I don't care, because it always comes back. But you can do better. We can do better. You don't have to do that. And they don't always bounce back.
For people who want to get engaged with how they might benefit from your services, where should they get plugged in?
You go to my website, it's pentoport.com. You can sign up for the 5-week free trial of the midweek reality check. It's only $50 a year if you want high-level insights of what I'm thinking about the economy and markets. If you have $100,000 to invest, I'll manage the money for you. And I'll hopefully get you out in time before big debacles like we've seen over and over again, and get you in the right sectors and asset classes when the time is appropriate.
Michael Pento, we just are grateful, as always, for your presence here with us on Liberty and Finance, and just thank you for joining us, and we look forward to having you back sooner next time. Sorry it took me so long to get you back on this time on Liberty and Finance.
Thank you again, Dominic.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we will let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be double boxed, fully insured and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Elijah, my brother Kaiser, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.